and his undergraduate degree in government from Georgetown University. So quite the resume there, and we are excited to hear about what we've been doing at the corporate level, at the federal level, with our organization. So take it away.
Thanks, Roz, and thank you for inviting me. Just by explanation, I'm in a hotel room in Dallas because I was down here, and I was on 3 panels yesterday for the Crow Holdings annual meeting, and there was obviously a lot of discussion and interest in what's going on in Washington. So I think everyone has their eye on how our people in DC are going to impact everyone's lives going forward. And there's a lot of let's just say there's a lot of nervousness out there from what they see. So with that, and just by way of, one of the people who I was dealing with is Lawrence Pelosi, who works for Crow, and of course, his aunt is former Speaker of the House, Nancy Pelosi. So there's quite a divergence, or let's just say a diversity of views presented on some of these issues. But let me get into some of this. First of all, the Congress is on recess for 2 weeks. They're coming back. When they come back, one of the big issues they have to deal with is Ukraine funding. And connected with that is, if you've been watching the news, is Marjorie Taylor Greene from Georgia basically threatening to take down the speaker if he proceeds with Ukraine funding. So that's going to be kind of the central story for the next week, and so we'll have to deal with that. I think yesterday or today, you may have seen a blog that I wrote. It's really referencing the Biden budget proposals that he sent mid-March. And, most people, when they hear the White House sends a budget to Congress, they're used to hearing that it's dead on arrival. It's not anything to be worried about. But this one's a little bit different, only because it's an election year. And so because it's an election year, it's really a campaign document saying this is going to be our plan going forward. So if President Biden wins, like all presidents, he's going to claim a mandate, and he's going to move on some of these proposals. But even if he doesn't win, it kind of becomes the standard Democratic playbook going forward, at least in terms of an opening bid. So here's some of the things that are in that budget. And just to be balanced, there are some good things in the budget. He proposes to increase the low-income housing tax credit, for example, and then some pro-housing provisions, which we are supportive of. But overall, the list of things that can impact commercial real estate are long and troubling. Here's an example. Capital gains, primarily. Right now, it's at 20%. And if you add the net investment income tax, which is kind of a capital gain tax, it's 23.8. President Biden would increase capital gains for people over a certain income level, 400,000, to basically 39.6, the ordinary income rate. He's right now it's 37. He's also proposing to increase the ordinary income rate to 39.6. He's also expanding that 3.8% net investment income tax to 5%. So essentially, your capital gains will go from about 23% to 44.6%, right? That's quite a massive increase. The other thing that he's proposing is modifying estate law so that assets that currently get what's called a step up in basis when they get transferred, when someone dies and gets transferred, essentially the price, the basis of an asset, purchase price, just to be simple, when a decedent dies and that the property becomes part of the estate, the basis becomes the fair market value at that time. So if you bought a property 20 years ago at, just for simplicity's sake, $1 million, and then the person dies 20 years later and the property is worth $10 million, then the basis would move up to 10 million. So then if you sold the property for 11 million, you'd pay taxes on the 1 million profit, right? What Biden is proposing is that you would change that basis calculation to basically carryover basis. So that property that you bought 20 years ago at 1 million that you now pass on to your heirs would be immediately taxed. The entire appreciation would be immediately taxed. They have some provisions that would, allow payment over 15 years, but the big problem with that is that it would just automatically increase taxes to an incredible amount. And so that's something that has garnered the attention of a lot of our members who've been, engaged in owning property for quite a long time and not disposing of it, planning to leave it to their heirs. If this was a perfect world and we were starting from scratch with all of us might write a different tax code, but we have an existing code, and there's something that policy professionals call, path dependency. People have been making investments and planning their lives, and all of a sudden you're ripping, it out of basically by the roots from the tax code, and that's a little bit unfair. Another example of that, he would eliminate, President Biden would at least propose to eliminate Section 1031 like-kind exchanges, primarily for commercial real estate. He would keep it available for assets under $500,000, but anything above that, you wouldn't be able to defer taxes on it. Again, 1031 like-kind exchanges have become an integral part of sophisticated commercial real estate transactions. So he would be disrupting a lot of markets in our view. Another thing that he would be doing, obviously, is increasing the corporate tax rate from 21 to 28%. There are other provisions in there that affect real estate. The major ones that I've talked about you've heard. One that is still controversial is carried interest. He again proposes to increase tax rates on carried interest and promotes from capital gains, essentially making them ordinary income rates. So again, a doubling of the tax on promotes or carried interest. And you have to remember that in 2017, basically the law changed how carried interests are treated so that in order to get capital gains, you have to hold it for 3 years, not just 1 year like all other capital gains. So they already made some modification to make sure that for someone who had a capital gain rate applied to a promoter carried interest, that it was truly something that was held over a longer period of time. But it's still a kind of a scalp that you can use politically. They talk about hedge funds making so much money based on carried interest, and everyone hates Wall Street hedge funds, so it becomes a potent political tool. But for our purposes in real estate, they serve a very useful purpose in terms of rewarding entrepreneurs and essentially rewarding risk taking. So we're going to be making that same argument. And in fact, for those of you who showed up for our chapter leadership, you know that we've already started talking about tax policy with Congress. Here's in terms of the lobbying and how this works. What people need to remember is that we're dealing essentially with people, right? It's not just ideas that don't change. And by that, I mean, the people who you are now hoping to pass these laws may be different from the ones that you've dealt with in the past. And so, for example, there are only 5 Republicans remaining on Ways and Means that were there when the Trump tax bill passed in 2017. So there's a whole process of education that we have to go through again. And of course, because it was such a partisan bill, Democrats aren't exactly running to help pass some of these things. Now, behind closed doors, they understand, a lot of Democrats will say they understand 1031s, they understand the impact of capital gains, but politically, they're not out front siding with real estate, particularly when you have nominally a real estate developer running for president against their president. So for this period of time, it's going to be a very difficult political navigation that we have to do. Here's my worry going forward. If obviously nothing's going to happen before the election, probably not much is going to happen in the lame duck. Perhaps some extensions, but most probably this is going to be the big discussion and debate in 2025. That's because the Trump tax bills and all these provisions expire at the end of 2025. And so that would basically increase tax rates for a huge number of Americans automatically, right? And so Biden, if he wins, um, will not be running for re-election. There won't be any political repercussions. He has an enormous amount of leverage simply because he can just let the tax rates expire. So there's going to be a lot of pressure on politicians to come to some sort of negotiated settlement on this. That isn't the case when you have these budgets that happen prior to an election and when there are no expiration dates. As we know, Congress only acts when there's a crisis or a deadline. And this is going to be a deadline. And it can be a crisis if you start thinking about the level of debt that the U.S. has incurred and the projected debt and the trajectory, which is not good. So my worry from a real estate perspective, from our association's perspective, is that in 2025, we're going to be arguing for continuation of these tax policies in an atmosphere where the other side is going to be arguing for increased child tax credits and a lot of other tax credits. There's going to be all of these other industries at the table asking for their, proposals. So we really need to be strong in terms of showing how some of these changes might really do more harm than good in terms of the economy. And so it's going to be a very challenging discussion going forward. And we've already started talking to people now because you have to start educating folks. The other issue that we've been talking quite a bit about is the availability of capital and credit for real estate. And I don't need to tell you that the interest rate increases that the Federal Reserve undertook, basically 11 interest rate hikes in a matter of a year. They moved interest rates from near zero to over 5%. That's obviously had a deleterious impact on our industry, particularly if you're an owner of an office building that now is highly vacant. You have higher insurance costs, you have higher labor costs, you have inflation, and oh, guess what? Now you have to refi, and you have to refinance, and your debt service is going to be increased. It's not a pretty picture. So banks and banking regulators have really been, maybe not officially, but telling banks to lower their exposure to commercial real estate, which again makes it harder for our members to get loans. And on top of that, the Federal Reserve has been contemplating this regulation, which is known as the Basel III Endgame regulation. And it sounds very arcane and weird, but Basel is a city in Switzerland where all the international banking regulators, have a coffee and decide how they're going to run the world. The Basel III regulations basically were something that arose after the 2008 great financial crisis to make sure that banks are properly capitalized. This is the end game regulations because they're wrapping up all their the regulations that basically were meant to respond to 2008. Well, the problem now is that banks are well capitalized, and the regulators will say they are well capitalized, but they're proposing to increase the capital requirements on major banks by nearly 20%, on an average of 16% across the board, and on some of the bigger banks like J.P. Morgan, it's about 20%. And that in an environment when banks are already very reticent to lend to commercial real estate is not helpful at all. It's what economists call pro-cyclical. You just basically add to the problem. And there is no treaty, there is no law, there is nothing that requires the Federal Reserve to actually pass this regulation. So we've been very active in terms of making our views known to the Federal Reserve. The good news is that Powell has indicated recently that when they issue this regulation, it's going to be very modified. I think he's heard a lot of these concerns. So that's, from our perspective, that's a good news story at this point, and we'll see when that comes out. And then the other thing, obviously, that we've talked about quite a bit is the regulatory environment. We've been very active on that front. The Securities and Exchange Commission had a regulation you may have heard me speak about this, but essentially it's a climate disclosure regulation that was being imposed on major corporations, and it would require corporations to disclose some of the dangers that climate change might do to their basically their bottom line, which makes some sense if you own hotels in Florida and the rising sea is going to start flooding your hotels. You can kind of figure out how much that's going to cost you and account for it for purposes of the investors. And then so that something like that would be called a scope one. A scope two greenhouse gas emission measure. And these are measures of greenhouse gas emissions and risk disclosure. So the cost that I just alluded to would be a risk disclosure. Scope one measures would be how much energy you use directly. And scope two would be how much energy is involved in the things that you do in your endeavors. But scope three was the one that really was problematic for commercial real estate. And scope three requires, let's say you're an owner of a building, you would have to keep track of everything that is involved in what's called the value chain of the product. So if you had a tenant that was receiving raw materials to work on to create their product, you'd have to account for the trucks bringing in these raw materials and how much greenhouse gases were emitted by those trucks. When they finished the product, where it went, you'd have to account for all of those greenhouse gas emissions. And there were a number of measures that you would have to account for under scope three that we don't have the information for. So it was really a burdensome sort of thing. And it was a regulation that applied to major corporations. But the problem for us is that if you're doing business with a major corporation and they need to disclose this sort of information, they're going to have to ask you for it. And so if you're doing any business with Amazon or Walmart or any of these major companies, they're going to have to disclose this sort of thing. And so we were active on that front. The good news on that, again, is the SEC basically issued their regulation, but they're not including scope three. They're only including the other ones that are more easily measurable. And that's a good news story as well, because a lot of our major companies are already doing some of these things. You know, everyone wants to be pro environment and green. So from a public relations perspective, a lot of our companies are already doing that. So it's not as burdensome. Scope three would have been, but that's not going to happen. The bad news side of this is that our good friends in California, which is the fifth largest economy in the world, passed their own climate disclosure regulation. And now corporations may have to abide by the California law, which means they're going to have to be doing it anyway. We'll see how that plays out. There's a couple of years as the regulations have to be written in California, and we're working with our NAIOP California chapters on that to maybe minimize the impact on our membership. But that's something that we have to keep an eye on as well. And I think that's all I need. Oh, and then finally, of course, we've been working on getting Congress to pass an incentive to help some underutilized commercial structures be converted to housing. And this kind of gets to the problem that a lot of cities have with their downtown, downtowns, which are basically not empty, but much less active than they were before the pandemic. And with kind of the permanence of hybrid work patterns, a lot of cities are still dealing with 3 days a week as opposed to 5 days a week at the office. You have less foot traffic, less economic activity in these downtown areas, so that ends up bringing in less sales taxes. Office valuations, I think the last year, at the end of the year, the office vacancy rate was 19.6%, which is the highest since the 70s. So office valuations obviously have gone down, which means less property taxes, and transactions aren't at the level that I think a lot of people expected. I think a lot of folks are waiting for prices to come down so they can swoop in and buy these buildings, but the owners are not being very cooperative at this point. So sales taxes are down, property taxes are down, revenues for cities are hurting, and at the same time they have a huge affordable housing crisis. Some of it, very honestly, is their own creation. A lot of local regulations and barriers to the production of housing leads to a diminished supply. But be that as it may, we have these underutilized commercial structures that could be, if given enough incentives, converted to housing. It's not a solution to the housing issue, but it's something that could contribute to solving it. So you kind of deal with a bunch of different problems at once. And so we've been trying to get Congress to pass or introduce a tax incentive that would be about 20% tax credit for the eligible conversion costs of converting a commercial building to housing. And there would be some affordable housing requirements imposed, obviously. But we tried to make it very broad. So, it doesn't have to be an office building. It could be, it could be in a suburban office park, for example. We're trying to, right now, where we are on that discussion is someone had brought up the issue of perhaps highlighting seniors housing, because that's another need that's out there. And it's been harder than you would think because there's a lot of bipartisan understanding of this, but there's some strange politics sometimes at work here. So, for example, without naming names, I've had Democrats who basically have said they have a gentrification problem in their districts. And by that, I mean, they don't want too many people who make too much money coming to their districts because they fear that that would drive rents up. And so if you're a poor person living in these districts, you may not appreciate new office buildings that provide some affordable housing, but that bring in a different mix of incomes. And that's just the reality, political reality that they're dealing with. It's not something that you would think would be a problem, but it is. And so we're trying to work through some of those issues to give folks comfort. Now, obviously, this is not going to happen anytime before this term is over. But from the real estate perspective, from the NAIOP perspective, a lot of our chapters have been asked by local governments to contribute to solving the housing problem. And our response is, look, we build offices, industrial warehouses, and we have mixed use, but it's not our fault. But of course, when they're looking for higher taxes, they look to us. And so this gives us an opportunity to kind of not just be against something, but also be for something that could speak to their needs. So obviously, we want to see this introduced. Mike Carey from Ohio has been working with some California Democrats. We're close to introduction. Hopefully, when they get back, if we get past this Ukraine issue, then we'll have a bill introduced that we can push next year. And Roz, I think actually, I was going to stop there, but two quick things on states. Colorado, we've been very active in terms of permit reform. Our Pennsylvania chapter is going to take it up and try to push it there. We've had success in North Carolina and Georgia on this, and essentially, it takes so long sometimes to get these permits approved that we've streamlined the process. We've afforded, we have a mechanism that allows third-party, basically approvals to occur. Obviously, the governments are very wary of contracting out some of this stuff. But we've given them comfort. Pittsburgh's going to be looking at it as well and see if they can push it. And then just something to warn people about, Colorado is dealing with something that they call Regulation 28. Everyone wants to be green. The governor of Colorado decided that he wanted to be net zero by 2050. Well, that's not good enough. So now he wants to be net zero by 2040. So they have this regulation that imposes fines on buildings and structures if they're not meeting certain requirements. And so something that happened recently, for example, one of the hotels, in fact, the hotel where NAIOP is having a conference in 2 years, got a letter from the department that regulates this in Colorado, that if they didn't make certain changes, they would be fined $87 million in 2 years. And they also sent that letter to the hotel's lender. So they're causing a lot of a lot of heat being created by this effort to reduce, the climate change. So we're trying to really make it. Basically, there's some litigation going on in Colorado that we're fighting. But I throw that out there only because you can see some of these things happening across states, and you're likely to see that in your state as well. Roz, I'll stop there and open it up for questions. I know that's a lot, but I've had too much coffee this morning.
Well, there's always a lot going on, and I know that there has been, we are required for buildings over 100,000 square feet need to start reporting benchmarking for their energy, and 50,000 square feet starts, I believe, in 2025. So that and yes, there's going to be more because there's several pieces of legislation that have been introduced in regards to that. And the reasoning I've been told is because commercial real estate buildings apparently are one of the worst offenders of the environment. And I'm not sure where they got that information, but that is the reasoning why our buildings are being targeted for that type of
what's interesting about that, Roz, is that there's this figure that's thrown out there, like 40% of greenhouse gases are due to the buildings, right? That's what they say. But when you actually get behind those numbers, it's a lot of that is residential. It's people's houses.
Right.
And so the commercial is actually not that much, but obviously it's a much better talking point to say 40%. And so then they'll say 40%. And then, oh, by the way, let's impose these energy efficiency measures on commercial buildings, and that'll fix it. And it's really comparing apples to oranges, and that's for.
Yeah, and I think unfortunately, what all this basically paperwork is doing is probably increasing greenhouse gases, but are making certain companies rich off of compliance. And I'm not sure where the direct benefit is for the environment, which is, I would hope, is what the goal would be to make those reductions. But yeah, and it's, obviously our three topics have been capital markets, adaptive reuse, and taxes, which you covered quite well. And obviously there's potentially will be some, well, there will likely be some changes because with the tax environment expiring, it's either clear it will be expiring or changing or something will be happening. So we're really happy that you're following that so closely. But I'd like to open it up to the audience. We have 23 people on the call today. So if there's any specific questions, feel free to either raise your hand or just chime in. Okay, well, don't worry, I have lots of them.
So, I have one, Roz, if you want the audience to go before
great,
your
Trevor,
questions.
Go right ahead.
My question is related to the tax credit related to conversions. My first question is if there's any political or otherwise reason that it's only focused on conversions to housing as opposed to other uses. And the second question is, can that credit be used with other credits such as the historic tax credit or some of the energy production credits?
Yeah, great questions. The reason it's kind of limited to housing is because that is a need that a lot of folks have. So that you can't really, to be honest, you can't really go to Congress and say, hey, give us a tax credit to help out real estate developers convert to something that benefits them. There's got to be a tie-in to a public purpose. So that's part of the reason that's in there, because it's something that I think is a bipartisan acknowledgement that all these communities, including rural communities, have a real housing need. The other two questions that you had, we had a lot of discussions on how to make this work with the historic tax credit, because what we didn't want to do is have one credit cannibalize the other. And, the historic tax credit requires a lot more things to qualify. So the historic tax credit people were worried. And so what we've done is actually we've allowed these to work together. So for example, if you have a historic tax credit project and you also, well, let's put it this way, if you get this tax credit and the tax credits are going to be, we kind of had to use an existing structure. So the tax credits would be allocated by a state housing agency, right? So if you got an allocation of this conversion tax credit, right, and you could combine it with a historic tax credit, you would get half of the conversion tax credit. In other words, the total amount of a credit you could get might be 35% if you combine both of these, right? And then we also provided a bonus for hard to develop areas. So there's it can be a rich tax credit in some sense, and we wanted to make sure that these tax credits would be additive and not hurt each other. The other issue is we wanted language in there that would allow you to transfer these credits like the energy tax credits. And so there's a transferability provision in our legislation. That was a hang up a little bit with some Democrats in the House. We pointed out that this was the Biden administration did this for energy credits. And, you need this so that organizations like REITs and nonprofits might be able to take some of these credits. I mean, they can't really use them because they don't have, a taxable income. So, but you want them to be able to use them and they could sell them or syndicate them. So that's also kind of the vision for the legislation.
Understand, appreciate the answer. The only other item that I would add is, if it's possible, ironically right now, the historic tax credit projects are not, you can't combine them with any of the energy efficiency related tax credits that were in the IRA, like the 45L credit. And so buildings that are historic and didn't meet previous energy code but want to be updated currently can't utilize funding sources that new construction projects are able to. And so it would be good if that could be changed at some point in time, but I know that's a separate conversation.
No, that's a conversation I probably would like to pursue with you if we can, because I know that it hasn't been raised
Certainly.
in the context here, but it's a good point.
Okay, and we have a question from Wayne Barnett, and it's focused on the comments regarding Colorado. So there's New York City's carbon tax law, which was focused squarely on commercial real estate. Are other states taking a cue from New York City, which is a local law 97?
Yeah, I think a lot of what's going on, and this shouldn't come as a surprise, there's advocacy groups that had been trying to do this at the federal level. They haven't been successful, so they've basically taken it to the state level. And so they are communicating. So for example, the Colorado folks joke that a lot of the people who are running these offices in Denver and other cities in Colorado came from Seattle, right? So you have this sharing of information and efforts to push this at the local level. There's also there's a group, very, very capable group called the Institute for Market Transformation that pushes a lot of this stuff out there on building performance. For example, or they were advocating. We've had discussions with them. They were advocating that buildings would be graded on a number of with a number of elements. Some of them made sense, but one of the elements was where they got their energy from. So if you were a building in a city, and let's say in Nevada, and you got your energy from a hydroelectric dam, you get an A. But if you were in some of the city where energy was provided by a coal-fired power plant, you'd get an F, right? And our response was, well, that's not our fault. That's not, the fault of commercial real estate. And the response was, yeah, but we want to keep the pressure up. And so they're using some of this to basically apply pressure to all of the industries in order to achieve, their agenda, and that's a political thing that's going on, and we need to be aware of it. So yeah, it's a great question. They That's why I brought up the Colorado thing, because I think it's important for all of our states to know what the other folks are doing, because it may come your way.
Yeah, I say it's coming and it's here, and
Yeah.
it's moving. So we're following that too at our state legislature. So we'll keep you posted. But when you have one party control, it is difficult to hear other viewpoints on a lot of those issues.
Yeah.
Any other questions or concerns that anybody else has? Well, I also wanted to sort of piggyback on what's happening at the state capitol on the conversion of utilized buildings tax credit that we're moving here in Minnesota. And that bill is actually being heard today at 10:30. And it is another sort of tool in the toolbox, so to speak, to help some of these underutilized buildings have a carrot, so to speak, to kind of move forward and convert these into something that will increase the market value and obviously not erode the tax base. And so we're excited to see what will happen with that particular piece of legislation. And I think I'm also going to just quickly point out that we did have our chapter go out to Washington, D.C. Oh, Trevor's got is that a hand or is that a clap?
No, it was clapping for the conversion credit. Sorry, Roz.
Oh, okay. All right, terrific. Yeah, so hopefully we'll get some action. And just, getting back to that, because it is past, it's not a budget year, it's a policy year, and it's sort of late in the game. Our hope is to continue to get traction on it. I don't know how realistic it is that it'll pass this year, but it's certainly making progress, and we're I know that Trevor's been involved with that and others are as well. But if you want to reach out to your legislator about supporting that piece of legislation, please don't hesitate to do so. Anyway, so we also went to the Washington, D.C., and were able to meet with Representatives Emmer, Omar, Craig, Senator Smith, and Senator Klobuchar's offices, and talk to them about all these different topics and how all the areas of whether it's the credit markets, the tax impacts, or adaptive reuse would affect our industry with those. And we also had August Brueggemann, Nate Erickson, Dave Anderson, Stephanie, and Nick Trevina also join us. And it was a really impactful trip. I have to say that, you never really know if you feel like you're making any difference. And I really felt like we had a positive conversation, and we did mostly meet with staff because like the Senate wasn't meeting at that time, and we were fighting with the counties that were there at the same time as well for our but a lot of times just bending the ear of staff also does make an impact too, and we felt really good about our meetings there, and also the program in general. And Stephanie, we won an award. Have we even announced that?
Yeah, we won the large chapter award for legislative affairs. So yes.
Yay. So good job. And also we also had our day at the Capitol here in Minnesota as well. So Commercial Real Estate Day, we partner with our other commercial real estate colleagues with BOMA, MNCAR, MSCA, and had a very good turnout and met with a lot of different legislators, both in the House and Senate, and I heard a little bit more about what was going on with them, but it was really great one-on-one conversations that we had throughout the day. It got a little long, but it was easy to get different people to come in at different times. And so we ended up having some great dialogues with them as well. And I also want to quickly just give some updates. We been working a lot on data privacy, especially when it comes to tax appeals, and working closely with like the assessor's office so we can kind of come to some agreement. And Senator Latz is carrying the bill in the Senate. And at the same time, we had another bill that came out of the blue that's supposed to be technical in nature, but basically it would dismantle all the work that we've done with data privacy. And I think that I just got something from Donovan. He said something about this, so I'm going to see what he said here quick. Oh, I don't know where it went. Donovan, do you want to chime in on that?
I think he may have logged off. I saw
he
him
may
before.
have. He maybe had to go.
Yeah.
Well, anyway, so that's like another something that we didn't have on our radar, but there's just basically in a disagreement of the agency feels that their wording is perfectly fine, and we have all these lawyers who actually work on tax appeals saying like, you just dismantled all the data privacy that we have. And to put it in a nutshell, when you want to appeal your taxes, you have to give everything in the kitchen sink to the tax assessor. All of your leases, all of your rent rolls, all of your data from past years and what the future will bring. And when you start going into court, some of that data becomes public, and it's never intended to be public. And so we're trying to keep it private. And now they're saying, oh, no data is private anymore. And it's like, wait a minute. I think there's some unintended consequences here with this language. So we're continuing to work with now the agency side of things and saying like that we don't feel that that's what a court would agree with. And, you know, luckily all you lawyers, you know, how this fun stuff happens, but we are following that very, very closely. And then August also brought up the Senate file 3164 that's also being heard, and that's in regards to requiring prevailing wage for TIF projects. When you get tax increment financing, you know, certainly there's lots of strings attached, but we have been noticing a ton of employer mandates moving forward from last year and this year. And so prevailing wages is another one of those issues that we're talking to folks, but it's sometimes it has been falling on deaf ears because they're like, this is what we believe is the right thing to do. And we don't care because you're the filthy rich, you know, business people who aren't paying their fair share. So those are some of the fun things that we're dealing with there. And what else can I tell you? There's probably, I think, 30 bills that we're trying to track really closely that are sometimes making movements, sometimes not. And again, there's still about 10,200 bills in total that are, this is the highest number of bills I've ever seen in my life. And that's why it's been really tough to stay on top of seeing what's going to be moving forward and what's not. And like I said before, one bill, like it didn't meet committee deadline by March 20th. So they just re-referred the bill to taxes. And tax bills don't have a deadline. They can be passed at any time, as long as they don't cost any money, right? Well, when they're looking for revenue, they can pass a tax bill at any time. So those will be closely followed until March 20th. Or excuse me, May 20th, when they hopefully sine die and don't go into special session. But I'm pretty sure that they won't do that.
Good morning. So the increase in the amount of bills is really geared to revenue generation specifically, or I mean, is there another reason trying to drive the increase in bills, or from your perspective?
Yeah. So if you caught on to the budget forecast, so we have a like a $2.7 billion budget surplus right now. However, we have a structural deficit and the stuff in the future. So they know that they can't spend a lot of money right now unless they continue to find more revenue, because down in the future they have a deficit. And I've been told actually the reason for that is there's additional spending that they weren't expecting, both in health and human services with people with disabilities and also in the education department. Remember that they passed full breakfast and lunch for all students. And I think that that program has become a little bit more expensive. Let's not forget about the paid family leave and medical leave and safe and family time. There's several different ones there that I'm not sure that that's going to be fully funded, even though the structural imbalance actually is also, I think, tied to some of the immigration policies that when we have 28,000 undocumented new immigrants in Minneapolis alone, and those people have needs. And so I think that is also playing a role in some of the challenges that we're seeing with our budgets. And I know that Minnesota is not alone on those issues, but for now we just have to take care of these people and figure it out. But I have not heard of anybody addressing the structural deficit moving forward. I think it's one of those that'll be dealt with by future legislature.
Yeah, I guess the only challenge is complicated tax structures make it less competitive, right, from a commercial standpoint. So not sure if that helps in the long run, right? If you make it, I mean, I live in Pennsylvania, Philly and PA, and Philly's got some very complicated tax structures, and businesses move right outside of the city for that reason. So
yeah, and normally when you raise the costs, it gets transferred on to whether it's the consumer or the end user. So I don't know how that helps housing affordability either.
Right. They're legislators, that's what they do. So.
Yeah. So good times, man. Yeah. So I don't know if anybody has any questions or concerns on any of the local stuff that we're working on too. Wow, quiet group here. Amazing.
Well, I have a quick comment. I apologize. My colleagues in Minneapolis, they're involved. I live in Philly, but I kind of cover the country, so I drop into a lot of these meetings. Are there any upcoming events or conversations related to sort of the credit markets and commercial capital markets and all those things impacting commercial real estate in the region? Upcoming?
Yes, we're actually planning a breakfast program in May, and the topic is capital markets. We don't have the speakers finalized, but you'll see. We'll have that on the website probably next week.
Gotcha. All right, I'll start paying attention to that. Thank you. This is really good. I'm glad they sent it over. This is a really good update. So this sort of, it's just so much going on. I actually was in DC yesterday, and it's really amazing. A lot of companies, corporations, or otherwise, it's a lot of uncertainty. So with the comments around DC right now, we will see. So very interesting. Thank you so much.
Thanks, Wayne, for joining us and your comments. So, so anyway, getting back, real quickly, anything happening on the immigration front in Washington?
No, I mean, that's, I think we all realize that's the political issue that has been used for the presidential campaign. And I don't think there's any fixes that are coming. I mean, it is, if I know it's when you're in politics, you're inherently cynical, but this is a pretty cynical. I mean, the Biden administration could have had a legislation if they had done this last year. But of course, they wanted it for the election to benefit them. And then when Republicans did it bite, of course, then you can blame the Republicans. So it's just a blame game going on right now. And we'll see how this plays out. But right now, it's the strongest issue that Trump has. And, you know, I don't think anything's going to happen between now and the election.
Did anything happen with Texas where they were able to?
I think that law is still being litigated.
Okay. Yeah, well, they're in the heart of it, and there you are in Dallas, so
Yeah, and that's on the local news all the time here. So
I'm sure. I'm sure. Well, I know that you have a 9 o'clock that you have to run off to,
Yep.
and I don't know if anybody else has anything more, but I think that pretty much covers it. We are very, very busy at the state level, trying to do what we can to move forward with our initiatives. I mean, I actually am a little bit hopeful on this. We call it CUB, the conversion of underutilized buildings tax credit. We had a good meeting on that this week. And then I am hopeful that we will get some of this data privacy fixed. And just for background, there was an Oracle case where the Supreme Court in Minnesota actually said that the state legislature needs to fix this legislation. So that is our position. That is what we're moving forward with because it's the right thing to do. And people's personal information should not be spread around to all of your competitors in a very competitive environment. It's just wrong. And I don't believe that it was ever intended that this information would be made public. And we have figured out a way where the data is still being shared that for the people who need it, but yet it doesn't need to be in the public realm to be abused. And that's our position. And we're working very, very hard to make sure that is done correctly.
Hey, Roz, I can just say something. I do need to run, but anyone on the call, if you didn't get a chance to ask a question or want to reach out to me, it's suarez@naiop.org. Feel free to email me. And Roz, I'd love to speak to you at some point about your progress on that bill. You guys are doing great. You guys do a great job there. We're lucky to have you as a chapter, and I'm just thank you for inviting me to talk to you guys today.
Well, thank you so much for coming. Your insight is just amazing, and we really, really appreciate all the work that you do. And we definitely appreciate you taking the time to join us this morning. You're one of our favorite programs for sure.
Great. Thanks. Bye.
Thank you. Till then, May 2nd, come and check us out. And that's all we got.
Thanks, everybody.
Folks, thank you for coming.
Thank you.
Thanks, Roz. Thanks, Steph.
Thanks.
Thanks, August.
Thanks, everyone. Great updates. Thank you.
Thank you. I guess I'll sign off as well. Take care.
Okay.